Earnings week continues, and today our focus is on Hershey. Now, when it released it before the market opened, the company was down around 8% in the pre-market. It has slightly recovered now at around negative 1%, but they were terrible earnings. Now, when we take a look to see exactly how poor it was, in fact, the earnings per share adjusted came at 127. The market was looking for 144, so they missed quite significantly in our opinion on the earnings per share. And when we take a look at their revenue, 2.07 billion reported for the quarter, and as we can see, a double miss with the market wanting to see 2.3 billion. On top of that, they also lowered their forward guidance, which we are about to look at. Not a great sign, not just for Hershey Company overall, but also this does show that the consumer environment is weakening, and this is something we have talked a lot about when covering earnings over the last few weeks. When we take a look at their guidance, well, previously their top line, they expected 2 to 3% growth over the full year. They're now guiding the lower end of that at 2%, and previously the reported earnings per share growth as well as the adjusted EPS, they were anticipating no movement, in fact flat at 0%. They've now lowered the reported earnings per share to -3 to -1%, and we can also see the same to be applied for the adjusted earnings. They do see this down negatively, although at a fairly small rate. So not great at all. We also want to show you some other numbers that Hershey have performed very poorly in. Their bottom line, 181 million for the quarter. Same quarter last year, 407 million. Gross margin as well, you know we always want to see increasing margins as well as increasing top line. 40.2% from the same quarter last year, 45.5%, and we can also see the same poor results when focusing on the operating profit, 288 million, which as we can clearly see, a decrease of nearly 50% on a year-on-year basis, and in fact the margin itself down 860 basis points. Now right now in the market we can see it has recovered, so it is down around 1%, but we want to understand, is this a good company to consider adding right now? Has it essentially bottomed given the horrific results? It was down 8% in the pre-market. It does seem to have recovered quite significantly, or is this not a company we should even think about touching with the weakening of the consumer environment? Now, in terms of over the last year, it is down around 15%. Do bear in mind that one of the reasons for this was the increasing prices that we have seen in cocoa, which is one of their main cost drivers and therefore significantly impacted not just their top line numbers, but also the margins. Increase to cocoa prices, a decrease then to their gross profit margin. Over the last 10 years though, it is still up around 115%. We will shortly do a comparison to the S&P during that time, but it has come down, as we mentioned, from its all-time highs of $275, right now trading at $194. In terms of the 52-week range, well, at the lower end, as we can see, 52-week low, $179. And we only get one buy rating today from Seeking Alpha, a double hold from Wall Street and Quant, with a yield, as we are about to see, nearly at the 3% level, and the forward PE sitting now below 20, as these numbers are yet to be updated for the drop we have just seen. So let's take a look under the hood of this company. Now the updated yield, 2.81%. Their dividend still looks to be safe with an 80 score, and their growth, something we like consistently from this company. They do increase it at a double-digit rate year on year. We also note that it was reaffirmed a couple of months ago, their rating, which effectively means a dividend cut does look to be unlikely. Now in terms of the last recession, Great Recession, in fact 07-09, unfortunately, they maintained the dividend. They didn't increase it, but look, they also didn't cut it. They pretty much had flat sales, and that was well above the average of the S&P at -12, and they also significantly outperformed, -30%, with the S&P's return itself -55. Dividend growth, as we said, very consistent with Hershey overall. Over the last 5 and last 20 years, they have increased it double digits at 10%, but they only have 14 years of consecutive increases. Remember, the last recession, they maintained it, and that is why we do see a very strong 94 years of paying a dividend without a reduction. Now, a lot of regular viewers know one of the indicators we look at under valuation is dividend yield theory. States a company is undervalued when the current yield sits above the 5-year average. So that is our first signal there. Another signal, the forward P of around 20 is lower than the 5-year of 24.3. But bear in mind, we don't look at any of these models in isolation. We will conclude when we come to the valuation model. And we also note it is marginally higher than the sector of consumer staples at 17.5. Next thing we look at is the payout ratio. As always, free cash flow over the earnings, which is susceptible to manipulation by management through accounting. Blanket rule, 60% or lower, 70 for consumer staples, pretty much below 70 nearly every single year, 59 in 2023, 53 over the next 12 months. No surprises why that dividend does look to be safe and that they have been able to increase it at a very nice rate. Free cash flow per share as well. Remember, consistent increases over the long term is what you want. And in fact, they've nearly increased it 4 times over the last 10 years. Over the next 12 months, expected to increase very rapidly as well. So that is one thing that is nice to note. Free cash flow should always be one of those metrics you do consider before adding to a company. Sales growth, now remember we want to see 3 to 7%, and that is something we want at a bare minimum just to keep up in line with inflation at the lower end. 10%, 16 and 7 over the last 3 years. The disappointing part here is that they're only anticipating around 2% increase for full year 2024. Therefore, it is coming lower than inflation in this current year. Numerically speaking, though, we do note growth around 50% over the last 10 years to the top line. And whilst they do share buybacks, it is very minimal. As always, it does return excess cash to investor pockets by effectively giving you a larger portion of control of the company that you do hold. The next metric, very important one, the ROIC, return on invested capital, 10% or more or 12% for consumer staples. Give us the faith management are able to effectively allocate their capital. Now, it is very high consistently, and even though it has been decreasing over the last 6 to 7 years, around the mid-20s is a very strong number. Definitely one that we do like to see, and the fact that even with the sales that they have had, they've been able to maintain it at a very strong level. Operating margin as well, always love to see this increasing over the longer term, consistently above 16% as well, so some signs of operational efficiency. But bear in mind, from the earnings report that we just saw, the margins have decreased from the previous year, so something just to consider before adding this to the portfolio. Free cash flow margin though looking very strong, very healthy, well above the 7% on a year-on-year basis. Finally, we get to the net debt to the EBITDA, the earnings before interest, tax, depreciation, amortization. Below 4 for consumer staples. The number you see below, number of years it would take the company to pay off all of the debt net of cash on hand. And 1.49 is very strong. Now remember, we look at this, effectively it does correlate to both dividend safety and balance sheet strength. 1.49, well below the 4 that we want to see. 1.69 over the next 12 months, a very marginal increase. So no surprises when you couple this with the fact that the free cash flow payout does look to be healthy, that we did see that safe score for the dividend, and as we will come to see, the balance sheet also looks fairly strong. Now, we also want to let you know that we have released our latest weekly articles. If you want to gain access to this or any other articles, you can click on the pinned comment below where you can sign up and read straight away. And we have now released our August undervalued stocks spreadsheet, so you can take a look. We run through 35 of them, the first one being Visa, and as you can see, we do denote for each one that we do hold within our own portfolio. Next thing we want to look at is insider movement. Now, 0.34% in terms of ownership, with just under 4 million worth of sales over the last year. What we can see in quarter 3, we do note some selling of 286,000. Previous quarter, again, another sale of 860, and in quarter 1, around $1 million. Now, when we take a look at who these insiders are, we can in fact see that the CFO has sold around 3 different tranches, once every single month, July, June, as well as May. 1,500 netted him around $286,000, but this is purely just for the transparency to show you, as we don't believe bearish signals shown from insider selling. As always though, that is a decision you can make by looking at your own research, but we do believe they sell due to personal and financial reasons. We then look at institutional ownership, around 58%, around 12.6 billion worth of sales over the last year, which is a significant amount when you compare it to just under 4 billion worth of buyers during the same period. However, we do want to point out that over the more recent quarter, as well as quarter 1 in 2024, we do see a lot more buying by the institutions than they are selling. Now, whether or not they buy more or sell more or the same to be applied with insiders, you should always do your own due diligence and understand before you invest and have a strong investment thesis. Next thing we want to show you, not just the top line revenue that we saw, as we can see over the longer term, it has increased by around 50% and is fairly consistent on a year-on-year basis, but we also want to understand, does that same story get told on the bottom line net income? And we can see, in fact, from 847 million in 2014 to around 1.9 billion, some very nice growth. In fact, the bottom line grows at a quicker rate than the top line revenue, and from 2015, fairly consistent increases on a year-on-year basis. So this is a good sign. It's telling us that whilst Hershey may be having a slowdown on the top line revenue, their bottom line, due to their margins, are increasing at a much rapid rate. So that is one thing we do quite like to see. Next thing we look at then is the health of this company, total cash versus total debt. 472 million on the balance sheet for cash in 2014, 520 in the latest quarterly report, so very minimal movement. We do see a lot of inconsistency on a year-on-year basis, but remember, this number will never tell you anything in isolation, which is why we like to look at the total debt numerically and directionally, and we can see it has increased around 2.2 billion to around 5.7 in the latest quarter, and in fact the trend has been increasing over the longer term. But so far, when we do look at that net debt to EBITDA metric around 1.7, it does give us faith that the balance sheet for now does look to be safe, and the dividend as well does look to be secure. We then want to talk about the earnings, how they've been historically. Now, what's very interesting to note, over the last 4 quarters, they did actually have a 100% track record for a beat on the earnings per share. The Q2 that they just released today, even though they were anticipating negative 28% on a year-on-year basis, they did still miss, which is very unfortunate. And over the next 3 quarters, we are seeing a fairly mixed bag with 2 increases year-on-year as well as a decrease in Q1. Now, if they do hit their earnings per share estimate for December 25, we will see the forward PE will move, although very marginally, which just goes to show you the earnings per share growth is very minimal anticipated from 2024 to 2025. Again, these are things that you should consider before investing. Next thing we're looking at is the gradings. Now, for the valuation, they get a D+. As we can see, the P on a non-GAAP basis sits around 21. As we mentioned earlier, the sector does sit lower, 17.44. So if you are buying right now, bear in mind you are paying a premium of around 18.3% in comparison to the sector, and that pretty much comes through whichever valuation method you use. Hershey does trade at a premium. Now, this shouldn't put you off. Sometimes companies should be trading at a premium because they have some metrics which are a lot stronger than the overall sector. But as always, you need to understand whether or not, 1, it is warranted, and 2, whether or not, based on the premium, there is a sufficient margin of safety in the valuation. And again, we will come on to that shortly. In terms of the growth, well, they get a C+. Year-on-year revenue, nice to note, 6.4 given the sector median of 2. Forward looking, well, they just said now in their latest quarterly reports, they're anticipating around 2% growth. That is lower than the sector median of 3.36. And one thing we want to draw your attention to, and actually for Hershey, very poor, they're anticipating 2.8% increase to the EPS over the next 3 to 5 years, with the sector much higher at 7.8. So it is understandable why they do get that C+ in terms of the growth metric. Then we move on to the profitability, where we finally see some very nice numbers. They have an A-. Now, on a gross profit margin basis, 46%, nice to note, higher than the sector of 35%. Then we look at the bottom line net income, 18.1, whereas the sector is much lower at 4.46. And we can also see the cash from operations, 2.14 billion, much higher than the sector of 796 million. Now, for a quick recap, just one buy rating from Seeking Alpha with a double hold, a D+ on valuation, a C+ on growth, with an A- on profitability. We then want to see how they compared against others in the sector. Is the whole market facing some challenges? We have General Mills, Danone, the Kraft Heinz company, as well as a few others. Now, we have covered all of these on our channel, so check it out if you're interested. Hershey then down 13%. This is total return, including reinvesting dividends, the worst performing. But what we do know, the overall market, as we can see, has performed fairly weak. General Mills, negative 7%, Kraft Heinz up only 1%, and MKC down around 12%. And you could argue Tyson Foods at 13% and Danone at 9.7% isn't that great over a year. We then expand this to over the last 5 years, and we can see actually Hershey's hasn't been that bad at around 43%, the second best performer. And when we expanded over the last 10 years, we do know they are the best performing, up 171%. Now, whether this is great and this is enough for you over the next 10 years, always important to understand that the past performance is never an indicator of the future. Final question you need to ask before investing is whether or not you believe it will outperform the S&P over the longer term. Over the last year, while Hershey down 12%, the S&P up 20%. Over the last 5 years, S&P has significantly outperformed, and over the last 10, when we really maximize it, the S&P has outperformed, although fairly marginally, and we can see for quite a long time, Hershey had previously outperformed before the drop, as we can see in 2023. As always though, do bear in mind this is just one level of the investment thesis you should have. Ultimately, if you don't believe it will outperform the S&P over the longer term, then you could argue low-cost ETF could be the solution. Now we're going to jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now as you can see, our intrinsic value at just over $204 isn't dissimilar from Wall Street. Now they had a hold rating and we can clearly see why. Price target of $206, only 6% upside. And how we got to our $204 price, we ran it through 3 different models. The first one, the multiples valuation, companies in a similar sector and size, average P multiplied by the EPS, and we can quite clearly see our first overvaluation signal. But as always, we never look at any of these models in isolation. We then have the dividend discount model with the average growth around 12%. As we said, historically very nice increases. Though we did want to be very, very conservative, at 5.5%, we still get an undervaluation signal, so 1 for 1. And on the DCF model, we have the free cash flow year on year, average growth at around 18%. Now, previously, we had it around 10%. We have lowered it down to around 9%, so lower than analyst targets of around 10 to 12%. And we use the discount rate, which then gives us the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by shares outstanding, and we get our second undervaluation signal. So that is the average of the 3 models at $204. Bear in mind, you can grab a copy of this model by clicking on the pinned comment below and running in your own numbers, whether it's for Hershey or any other company. We then use a margin of safety, which we always start off with at 10%, and we execute on this if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. Well, if you believe that, then it is a buy at around $184. So right now we don't see a 10% MOS. In fact, at 5% is where we see Hershey right now. So if you are adding at this level, we only believe you are getting, based on the estimates and judgments we've run through today, a 5% MOS. For those that even believe 10% isn't enough, at 15% you would have to wait at 174, and at 20% around 164. As always though, do let us know your thoughts in the comments below. Is this one you're looking to add? Maybe on the weakness of the earnings, you believe it's going to come lower with the weakening of the consumer environment, or maybe this isn't one you want to touch at all. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified, and don't forget to join the free weekly newsletter so you do get our list of undervalued stocks as well. And also, we do have a Patreon if you want to see our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.